we're delighted to have Saul Nathan from Morgan Stanley with us today, and we just briefly want to talk about an aspect of listed private equity. So Saul, how are fee and carry represented in these investment opportunities in publicly traded private equity?
I think if you're talking about some of the big alternative asset management complexes that are listed in the US in particular, people like Carlyle or Oaktree or Blackstone or Apollo, the market has tended to look at these businesses on the basis of a sum of the parts valuation. And the sum of the parts is made up of several things, one of which is the management fee income stream, which comes from the fees that are charged on assets under management. Second is the fee that comes from carry realization and how that accrues to the GP. And then also there are other ancillary fees that private equity firms are charging. The market ascribes different valuation multiples based on the level of confidence it has on the future likelihood of those fees. Management fees are deemed to be relatively certain. You can project those out over a long period of time. You have persistence of assets. Successful asset managers continue to grow assets under management typically, and the management fees, all other things being equal, are reasonably straightforward to value. It becomes more complicated when you try to assign value to carry. Carry is event-driven, it's realization-driven, it's very much a function of the performance of the portfolio. And I think public market investors historically and still today would ascribe a much lower multiple on the value of that carry-derived income because of its lumpiness, its unpredictability, than they would to the management fees. And typically that ratio is somewhere between 2 and 3 times. In terms of multiple. Interestingly, today, really for the first time in a long time, as you think about looking at these assets as opportunities for investment, the markets are now looking at them partly as yield plays. And so we're attracting quite a new set of investors who are motivated by income, and the income is functionally derived from the realization of portfolio assets and the carry that creates for the fund. And so you've got some of these businesses that are trading now on 7 or 10% yields, and especially in a yield-starved environment such as the one we have today, people are looking at that potential income stream as being quite an attractive source for them.
That's probably also benefiting from the low yields around.
Absolutely,
well.
It's the virtuous cycle, if you like. When you have low financing costs, then obviously private equity can be quite active because they can buy businesses with a lot of very attractively funded debt. At the same time, that means it tends to be a more robust environment for realizing value. And you've got this confluence of, on the one hand, these investors being able to buy assets with very cheap debt, which is exactly the converse of the investors who are looking for yield in the market, searching for it and finding it in the other part of the balance sheet of the private equity businesses.
Excellent. Thank you very much, Saul, for attending our symposium today.
Thank you.